So our candy here is called Finding the Needle in the Haystack, the do's and the don'ts. What we wanted to do here is to raise a few statements, have those two esteemed gentlemen pit one another. So one's going to be pro and one's going to be con. And then we're going to have you use the QR codes to actually decide who you vote for. Okay? So with that said, it's non-personal, but I do encourage you to take stabs at one another.
Yeah, right. Vote right now.
Hold on. No voting until they make their stance, okay?
I didn't know this was competitive, but
That just changes everything. Full disclosure, before Sharon goes, we got thrown a whole bunch of questions that James and I had a chance to review in advance, and without knowing there was going to be voting and reputational potential, issues, we randomly selected agree or disagree, just so you know.
Okay, this is the first one. Okay, founders should aim to dilute equity as little as possible in early funding rounds. Okay, so Rob, you said that you agreed with this.
Yes.
What's your take on it?
My coin flipped agree with this, so that's it's a qualified agree. I think it's more a question of how much money do you need, right? So I think the answer is that it's important to have a very detailed plan when you're going out to raise capital. And it's a challenging environment, and everybody wants to raise as much money as they can. But the problem is that by the time you're going out to raise a reasonable amount of money, you've already taken money from other people, right? So you have investors, friends and family rounds, or early angel-type investors who have funded you. And if you go out and raise much more money than you need to reach the next milestone, then you're going to cause probably a hefty level of dilution to the people who put up with the greatest amount of risk. So I think that you don't want to overfinance. You want to take what you need to get to the next point that you need to get to. And I think it's important also to make sure that you present that in a very detailed way. We see pitches all the time, right, from companies, and everybody says they need 5 million, they need 6 million. Well, maybe you really need 4.4 million. And you can build in a cushion, but coming with a very detailed plan allows you to maintain the proper amount of equity. And you're going to need equity for later because, as you know, we venture capitalists are animals, and we want to try and get as much as we can for our investors as well. And the dilutional impact on people who have supported you is going to be significant. So I believe that you want to kind of make sure that you stay very disciplined with how much you raise.
Fair enough, James.
You're wrong.
Couldn't disagree more. Yeah. You're 100% wrong.
You're wrong, whatever you're about to say.
I know. There's no nuance in this discussion. It's agree or disagree. So here's the disagree. It's so look at this room. It's so incredibly difficult to raise capital that you need to be able to take it when you can get it. We saw so many companies going into 2020, 2019 or so, trying to be cute and maximize for valuation and getting to either an IDE or IND, and they turned down really strong term sheets, and then 2020 came and it all went poof. So if you have those offers on the table, take the money, get it in the bank, and figure out your ESOP, figure out your dilution. If that investor is worth their salt, which you would think from an investor writing a large check, they'll figure out how to minimize dilution for the team. They'll re-incentivize. I mean, the conversation around an ESOP is just around valuation, right? So they'll figure out how to incentivize the team to keep it going forward. Take the money when you can get it.
Very eloquent, but wrong.
That's not what, yes, it's working. So with that said, QR codes, guys, and start voting. Let's see what we're coming up with.
Faraz isn't here, so there would be some ad hominem attacks if he were in, some vulgarity, so we'll spare the audience that at least.
It's tight. It's tight. This thing is tight.
It's Friday morning.
Going up and down.
By the way, this is what it sounds like whenever we have dinner. It's completely the same conversation.
Rob, you're losing, my friend.
No kidding.
All right, I think we stabilized. So people agree with you, James. Take the money and run. I wonder how many of those 64% are founders. But With that said, let's.
Can we just comment on the whole thing? Because, as we said, James and I both, we have, the answer is it's a mix, right? The answer is it's a balance between these two things.
Yeah.
And, I probably agree more with James' position as when we looked at the conversation, but I think there are points to be made for being disciplined. But we all agree that somebody likes your opportunity so much, figure out how to make it work and take what you can.
Exactly right. Yeah, there's nuance between all of these points, and that's excellent to bring up, because how much you raise now is going to impact how much you have to raise later and the valuation and all of those things. So you really need to think through it.
All right. Next one. Raising capital from investors with ophthalmology experience is always preferable. Let's start with you, James, because you're disagreeing with this.
Some self-loathing in this coin flip. Disagree. I mean, as great and smart and knowledgeable as Rob is, or my team is, right? Forget sparing the 20 to 30 minutes explaining to a generalist what disease you're going after, the basics of it. That's fine. Use that time now, take money. Eventually, you're going to have to go and raise from those generalist funds that have much bigger pockets. Unfortunately, Rob and I can agree on that point at this stage. You're going to have to tell the story to that broader market at some point. And if you can't tell it to them now and sell it to them now, and you have to rely on our knowledge and expertise, then you're likely not going to be able to tell it later. So again, as great and as knowledgeable as Rob is, take money the best terms you can get. It doesn't necessarily have to be from a specialized strategy.
Rob?
So, how many of you really enjoy talking to people who don't know anything about ophthalmology? How fun is that for you guys, right? So the aha moment for us came, the first deal that we ever got pitched, and we decided we were actually going to launch a fund after having done lots of venture activity in the past, was speaking to an ophthalmology company, don't need to know who it is, and the CEO founder had no idea who we were, and started to explain the pathology of his disease state, which affected the cornea. And about 15 seconds in, I said, wait, just so you know, the two guys you're talking to were both ophthalmologists. And he literally sat back in his chair, crossed his arms, and said, wow, you just saved me 3 weeks worth of work. So, there is an advantage to speaking to people who understand this space, especially early on. Because the one thing that bothers me more as an investor is watching companies waste time raising capital, right? And the more work that you have to do to raise money means the less time that you have to do the actual work. So we want to try and have you raise the capital you need quickly and efficiently. Speaking to ophthalmology knowledgeable or ophthalmology-specific investors gives you the opportunity to use those investors to help you create a syndicate if necessary. They will advocate for you. They will be able to explain the science to people who are not ophthalmology savvy. They are accretive in multiple ways, right? We can bring in advisors, bring in teams, understand pathways and steps that you have to take that may be specific to your indication, and help advocate for you in terms of finding the support that you need to get those tasks done. And we're also committed to the space. So being committed to the indication that you're trying to solve, gives us a little heart and helps us to be a little bit more understanding when things go a little sideways periodically. So having an ophthalmology investor as your advocate and looking for ophthalmology, specific or knowledgeable people is going to make everybody's job easier.
Fair enough. So let's open the QR codes again and make you vote.
I was nodding in agreement as you were talking.
Oh my God.
And if I don't win this one, I'm leaving. So I don't care what you think.
I was
Close
helping you
though,
along
it's
by
close.
nodding
Just-
in
just
agreement
vote for
as
me
you
or I'm
were
out.
stating your case.
He's taking it personally.
That's right. I'm taking this one personally.
Oh my God. A
I
landslide,
take it
my
personally,
friend. A
too.
landslide, 68% versus 32%. So
Did I win?
you won.
Yes.
You won. It's yours. But there's a tiebreaker here. There's a third
Well,
one.
hold on. Let's just comment on that one thing because
Yes,
again,
please. Yes,
and
please.
I think it's obviously a mix, right? So it's the same commentary that we had before. That you should be finding ophthalmology knowledgeable investors who are willing to go out and help you raise your capital. I mean, I think that's the key. You're never going to find all the funding you need just from the ophthalmology specific world, and some of that has to do with, you know, how and when strategic partners are willing to get involved in opportunities in a meaningful way now, and that's a topic for later in the OIS session, I think, but ultimately you're going to need money from lots of other sources, and James's point is 100% correct. You need to figure out how to hone your story and make it concise and clear for non-ophthalmology savvy investors, and the greatest time to do that is early on.
Absolutely. You need to get that story fleshed out. But, you know, and in addition to Rob's point, just to add that, generalist funds are actually helpful, right? They are helpful in maybe broadening the aperture and thinking more broadly about different indications and market and strategic partners. But that said, they also rely on us and look to us and say, hey, if something's in your portfolio or you're looking at it, maybe it's a little too late for you, share it with me. I'd be happy to look at it because you've already vetted it.
Fair enough. Last one, bear with us, QR codes. A detailed roadmap for milestone and spend all the way to market is needed from inception. Let them vote first. No, sorry. You guys go. Let's start with you, Rob.
What did I agree or disagree?
You disagree.
I disagree. Yeah. Damn. I think we touched upon this a little bit, I think, you know, during some of the other conversations. You know, part of the problem comes back to funding. I think that it is very hard, it is very challenging, I should say. It's not hard, it's just a challenge for a company at an early stage to understand exactly where it's going to end up, right? There are a lot of things that happen along that pathway. And I think that it's good for you to have an idea as to where you want to go. I think you need to have an indication, and you need to know what you're trying to raise capital for in terms of building out a program. But I think having a detailed a detailed plan to go to market is sometimes getting a little bit ahead of yourself. You certainly need to raise capital to get to certain inflections, and you certainly need to know where you're headed. But if you go out and you're, you know, sort of IND enabling activity company, and you're talking about, you know, how big your sales force is going to need to be when you get out there, you're going to turn a lot of people off. Because we all know that things go lots of different directions as you're going through this process. And, you know, even from the investor perspective, I tell people that I think that we're really good at de-risking opportunities up until the point that you put the drug in a human being, because we have no idea kind of how things work out. And sometimes plans will change, indications will change. You'll become a platform technology when you didn't think you were going to be, or, you know, as David Esposito has said, you know, sometimes you try and do a quick indication to prove something, but you really know your plan is for later on. And you have to raise money at all those different stages. So I think that it's important to know what your plan is to get you to specific milestones for the amount of money you're raising, and having an idea of where you want to go, but being flexible enough to know that you're not going to have the perfect plan in place.
Fair enough.
Couldn't disagree more.
Shocker.
Shocking.
Yeah, the coin flip again. Listen, you're selling investors on market success. You're not selling them on the next milestone. You're selling them on the big picture. So if you haven't thought through how to get to market, and Tracy's discussion hit on this, at least at some stage early on, why should I take the time? Why, when I start asking questions, you say, oh, we'll worry about that later? That tells me that you haven't thought through the various risks and ways to mitigate them, to Rob's point, that you're going to run into along the way. So you need to think about that eventuality. You need to sell investors on that market access. You need to sell them on that success to get them excited. And, you know, even worse than that is the response of, oh, we're not going to have to think about that. We're going to exit after phase 1. Can't tell you how many times I've heard that. And that is, okay, great, good luck. So there's the response. So yeah, you need to think it through it. And again, Rob's wrong.
Okay, and with that said, let's vote. Last one. Make an effort, guys.
take it
Troy,
personal.
I want to see you scan.
Better be a landslide.
It better be a landslide. Yeah.
That was a call.
72
Yeah.
to 20. to 30. It's coming up. 71 to 29. But the gap is clear.
Yeah. Well, James, of course,
Sorry,
of course,
Rob.
James is right. I think the most important part of this particular question is knowing who your investor is. Certain investors are going to want to hear certain things, right? There are investors who I think are much more comfortable with the fact that they're going to be diluted, down the road because they see the bigger picture and they know how much money they can allocate to an investment. And there are certain investors who are not. And I think that we've said this before at previous OAS meetings that you need more than one deck when you're going out to present. Different investors want to hear different things, and if you have one pitch deck that tries to make everybody happy, no one's going to be happy. So I think that's critical to knowing, what you need to present. For us, for example, and I think this is something that's come up relatively recently within the last few years. We always felt like the last checkbox that we could do in our diligence was understanding whether or not someone's going to pay for your product. And we kind of felt like we were investing in science, we were investing in science, well-run scientific companies who had a great idea and a great indication. And then we said if it was deserving enough, it would get paid for. But that's not really always the case. So, payer analysis has become incredibly important early on. And having a commercial person on your team is something that's become much more critical. So, having that in place to me now makes me a lot more comfortable. You don't have to engage somebody, you don't have to pay them, but you have to have some idea about a plan. And I think that's something new that has come to light because, we've seen companies that have done the wrong clinical program, and it's affected their ability to move forward. So I think there are steps of the roadmap that need to be evaluated. I don't necessarily know if they all need to be funded at one time, but they certainly need to be thoughtfully presented in a presentation.
Yeah, I obviously agree, but you also need to, some of what Rob said is true as well, right? You need to marry that thoughtfulness in thinking through market access and the ultimate success of what you're developing with being nimble and the ability to pivot along the way, right? Because it's very unlikely that where you start today is going to be linear, but that doesn't mean they're mutually exclusive. You need to maintain that flexibility while also, focusing on what the plan is.
Fair enough. There's two more questions that came up that are revolving around networking, valuations, and expectations. So the first question is, how do I build relationship with potential investors? Broad question.
Are we agreeing or disagreeing, or is this just open?
No need to agree, disagree.
I
Just
disagree
give
with
us
whatever
the
James
keys
says, as a matter of fact.
to the
Okay.
castle.
It's easy. I mean, just start a conversation and don't force it and stay in touch, right? I mean, you're much better served just trying to get an introduction. Warm intros always help. But I think because we're both specialized within ophthalmology, we'll take any pitch and we'll talk to any company. But, it might not always be a fit. The timing might not be right. We've invested in less than 1% of the deals we've seen. But that said, the companies that stay in touch with us over time are better served. I mentioned Michael O'Rourke, who's out there. We talked to Ravana for 2 years before they were ready. And he was diligent. Let's meet up at this meeting. I'll give you an update. I'll reach out. David Esposito is excellent at this for existing investors, providing a cadence of monthly updates. That's fine. I see companies in my inbox, and I know that they're functioning, they're out there, they're executing, and then when they come back to pitch, I have a frame of reference. So I think that's the best way to stay in front of investors over time, while also respecting a no at the time, right?
So from your perspective, it's not a one and done. It's not one chance to showcase and that's it.
Almost never. And when it is, we'll provide that feedback very explicitly and say, hey, listen, maybe your time's spent somewhere else.
Fair enough. That's good.
Yeah, and the other comment is that you have to remember that, especially when you're dealing with people like us, we're committed to this space, right? We're committed to innovation and advancement, in ophthalmology. And if you have something that's compelling, but we're not able to invest for whatever reason, we know lots of other people who might be. So it's always good to try and just, even have just some dialogue with us, And I tell people this all the time. Right now, we're in fundraising mode. We're not doing a lot of high-level diligence right now because we need to focus on raising capital. But that doesn't mean I don't want to hear about you, because we have, a database of all of you for the most part in some way. And just adding material to that is going to end up helping us when it comes time to selecting, which companies we want to move forward for. We're living, breathing, kind of, unstable organisms just like you are. What we want to invest in might change. We might see different attitudes. We are, and I've said this before, we are not charities, right? We love this concept and we love investing in this space, but we have investors who expect return. And if it turns out that we see a real opportunity to have potential exit in a discipline or a space which is getting a lot of traction out in the world, we might go back and look through our database of all the companies that are in that space and say, hey, we know we were not interested 2 years ago, but now we are, so come on back. And it's just kind of the way it is. As much as I wish that I was my own philanthropy and had hundreds of billions of dollars to give every single one of you a shot, it just doesn't work that way. So I think the more people you get in front of, the better the chances are that you'll find somebody who wants to help you.
Okay, and the last question was with regards to valuations and expectations, what are angel investors expecting for an ROI? Very explicit.
Very explicit.
It's a very explicit question. I don't think I can
Is it
answer.
different than
I don't think I can answer that.
VCs? Are they?
I mean,
is it a different profile of investment?
I think a lot of angel investors don't expect a lot of return at all. I think that there's a lot of, at least my general experience is that the angel communities love a concept, and they like to invest in concepts, small amount of money in a real concept. I think everybody wants to make some money. One of the things that's become very challenging for us is kind of modeling, right? One of the things we like to do is figure out how much money we can invest now, what it's likely going to be worth at the time you exit. And guess what? We launched our fund in 2019, okay? COVID kind of had a huge impact on timelines and the amount of capital is going to need to be raised. Hard to plan for something like that, although we will in the future. But, we don't, there was a question that was asked at one of the meetings, maybe it was last year or 2 years ago, where there was a whole bunch of ophthalmology-specific investors up there, and they said, are you aiming for singles or doubles or home runs? And I think it was a universal, we all want home runs. So, I don't think I can give you a specific target. We don't work that way. I think that's more of a PE question that doesn't really apply to me at this stage, but I think angel investors are probably even less concerned about it.
Yeah, I'd agree with that. I think to some extent angels have become a bit more sophisticated with their groups, or just over, and knowledgeable about the space. But I would almost put that burden and onus on the founders and the CEOs of those teams on what valuation they're accepting, understanding that in most cases those people are your friends and family, and you don't want to alienate them if there's a successful outcome and watch them get diluted down to nothing. So really think through what that looks like. And there's tons of resources out there that, Rob and I don't have the 53 seconds to get into on how to think about that seed round and seed
50.
funding. Fill the space with more.
Well, with that said, I want to open the floor to questions from the audience. This is your once-in-a-lifetime chance. No, I'm just kidding. Your monthly chance to engage with VCs.
It's daily chance. It's the daily chance.
Everyone at once. Everyone wants to go to lunch.
Yeah, lunch is coming, I swear. So I just want to conclude this session. It's been a whirlwind. We were planning and dreaming about having an OIS boot camp for a long, long time, and there has been a lot of work done specifically by Maureen and team. Thank you so much. This is experimental at this stage. If you thought that this was answering some of your needs, or if this was engaging, or if you want to continue, for us to continue with doing this, there's going to be a survey sent once the video clips are going to be ready. So I think in about 2-3 weeks' time, this is going to be ready. We are really eager to look for your thoughts as to what would you like to see, how would you like to dive deeper. We thought of doing this for a full day or something like that, where we do mock negotiations, look over term sheets, really go down into the nitty-gritty details that would enable the young startups to overcome some of the hurdles, as well as engaging more in the mentor-mentee program. So we really look forward to your input. Please, please, please fill out the survey if you want this to continue. And with that said, I want to say again, thank you for you who came to listen. Thank you for everybody who was on the podium. This is unprecedented presence. There's a lot of people who participated in that. And let's kick the OIS out in the spirit of collaboration. Thank you so much.